Good morning. Welcome to our latest Burning Questions with a CIO webinar. My name is Nirdev Desai, Head of Sales at PSG Asset Management. On the back of the majority of the world having gone to the polls in 2024, 2025 has been a continuation of voices being heard and leadership in flux, affecting many aspects of our lives, from narratives through investment cases to markets that are flipping between hope and optimism and also angst and fear. Being able to have a steady investment hand, deep understanding of risk management, and decades of investing through a world consistently in flux, I'm very excited to have the opportunity to unpack some views with the Chief Investment Officer of PSG Asset Management, John Gilchrist. Thank you to the audience for the questions that you have posed to us, which we will use in today's session. We have collated common themes between these questions to ensure that we get the ones most at top of mind addressed by John. And so, without further ado, let's get cracking. So, John, morning. Less than 3 months ago, you traveled across the country talking to clients at our PSG investment outlook for 2025 and beyond. Can you please remind us what your key views were that you shared there and how things have unfolded since then?
Thanks very much, Nirdev, and thanks for everybody for joining us today. I think that's a great place to start before we get actually into the questions that have been sent through, because it gives a very good outline of our thinking and our positioning just 2 short months ago. So as you said, in January and early February, we went around the country and did an outlook. And there are probably 2 slides from that outlook that really sort of summarize our thinking at that point in time. So the first one you'll see up on screen now. At the time, I said it sort of came across as maybe too negative with all the red on that slide, but ultimately that proved in the short term to be quite prescient. And there were 5 areas that we were concerned about from an outlook and a positioning perspective going into 2025. The first was this extreme level of consensus around US exceptionalism. Everybody had the view that the US, after 2 incredibly strong years, was going to continue to drive global equity markets, and basically that was the only place to invest. This was further supported by concerns around Europe, concerns around China, and what was also interesting is that even though a lot of investors were cognizant of the risks associated with a Trump presidency and even some of the fiscal risks in the US, they chose to look through that and focus on this US exceptionalism narrative. There was an extreme level of confidence in this US exceptionalism also expressed. And we referenced the Bank of America Merrill Lynch survey that comes out monthly. It's been going for nearly 20 years. And it showed that cash levels across global investors were the lowest they've ever been. And the overweight on US was the highest it's ever been. And bear in mind that at that point in time, the US had become 74% of the MSCI World Index. So not only was the US at the highest level it's ever been within the global index that most people are benchmarked off, but people were the most overweight relative to that they've ever been. So that was an extreme level of confidence expressed by global investors. There also, to our mind, appeared to be massive complacency out there. And we referenced the VIX, which, despite the fact that there was a lot of uncertainty that was known up front in terms of how Trump's policies would come to play regarding the fact that markets were stretched, and in particular in the S&P 500, there were extreme markets in terms of the valuation levels that had been reached. Despite these, the market participants were comfortable to say, given what Trump did in his first term, where equity markets were used as a barometer of his success, he's not going to do anything too extreme that will disrupt the equity markets. And as a result, the VIX, the so-called fear index, was at pretty low levels. And we didn't think that was actually appropriate. We felt that showed some complacency. From a concentration perspective, this was also something that concerned us. And it was really evident when we put up a slide showing the contribution to the MSCI World from 2024 by country. And it was basically all about the US. The US had driven those returns. And within the US, the Mag 7 had obviously been a significant driver of that performance as well. So that once again concerned us. And then putting it all together, what was really concerning was that you had this massive confidence, this complacency, and this concentration in areas of the market that we felt were stretched from a long-term valuation perspective. So putting it all together, we were a little bit concerned from that. What we also did is, given that we're long-term thinkers, we said, let's step back. Let's take ourselves 10 years into the future. Let's position ourselves. We're working with Professor Johan Fourie, an economic historian from Stellenbosch University. And we said, let's put ourselves in Johan's lecture hall in 10 years' time. And given the longer term data, what could happen over the next 10 years that would be consistent with that longer term data and which might potentially surprise people in terms of the way they're positioned now? And once again, there were 5 things that we pulled out and we highlighted. We said you could see a lost decade from the US markets, given their valuation, starting valuation levels, based on a cyclically adjusted price earnings ratio and the long-term history of that. We also said that you could see a weak dollar. And I think that was quite a surprising view for a lot of people, given how strong the dollar's been for an extended period of time. And that was despite the fact that tariffs initially were seen as very much dollar strengthening. And the reason for that was some significant concerns around the fiscal situation in the US. And we actually even went as far as to say that the assumption that the US cannot go through a UK Liz Truss type of sell-off scenario where the bonds sell off due to a lack of confidence and the currency sells off at the same time. We felt that that was something that could actually happen despite the dollar being the reserve currency, and the complacency around that was once again a concern. We further went to say that based once again on the longer term history, you could see a scenario where US bonds didn't provide protection to equities, similar to what we saw in 2022, where the equity markets and the bond markets both fell. Longer term, that's actually the norm. It's only been the last 20 years where bonds have actually provided protection. And in particular, we said if there was a sell-off on equity markets related to supply side shocks, like immigration policies reducing the supply of labor, or like tariffs or trade wars, you could see the bonds selling off in that scenario at the same time that equities sell off. We did acknowledge that the knee-jerk reaction to any sort of panic would probably be a reduction in US bond yields. They are the safe haven, but we felt the immediate second-order effect, if it was inflation-related and if it was fiscal concern-related, that those bond yields would actually move up, that the bonds would decline, and they wouldn't provide that protection. And then finally, we posited that you could have outperformance from emerging markets over the next 10 years, given the long-term data, and you could also potentially have outperformance from South African markets, both of those expressed even in dollars. So from a positioning perspective, our positioning very much reflected that view. We didn't have a lot of exposure in the US. It was very selective. And then we had decent exposure in the UK, and we had exposure across emerging markets, including Hong Kong/China, Brazil, and South Africa. Finally, maybe what we can also refer to, because it turned out to be quite prescient, was a cartoon that we used during the Outlook, indicating that we didn't know exactly what Trump might do, but given his history, we felt there could be a lot of noise and potentially crises coming through down the line. And that manufacture of crises cartoon, I think, was quite prescient.
Yes, sad but true, hey? The world that we're finding ourselves in, it's a world that is in flux and moving very quickly. So, the next question comes from Trevor. So, Trevor, thanks for this question. When the invites went out, Trevor asked this question. So this was approximately 3 weeks ago. So, it possibly needs to be rephrased today, but I'll ask the question in any case. So, what will prop up US markets when Mag 7 loses its shine, which we obviously have seen over the last few weeks starting to happen? Are they going to be the main reason for a US market correction? And John, where are you, or will you be looking for opportunities as the market and when the market sells off?
Yeah, so I mean, when we were looking at it, and certainly back in January, February, when we were looking at it, we felt that, as I mentioned, the US valuations were extreme levels, and the exuberance was really focused on AI and focused on the Mag 7. So that was the area of the market that was most of concern to us. We like to shop in areas of the market that are out of favor. We look for opportunities that the rest of the market has missed, where there's sort of quality that has been overlooked. And because it's out of favor, those areas of the market tend to be cheap. So then we can find quality stocks that are cheap, and that really excites us. What we were seeing in the Mag 7 around the AI exuberance was the exact opposite. There was massive exuberance. They were in favor. The assumptions were pretty stretched, and then the valuations were pretty stretched. And I think it's really important to just once again highlight that great companies don't always make great investments. And there's no doubt that certainly within the Mag 7, maybe not all of them from our perspective, but there are some exceptional companies there with massive moats, almost monopolistic type of economics, that generate incredible amounts of cash, that have very strong balance sheets and great management. They are exceptional companies, and it's reflected in the way that they've performed and their market cap. But if exceptional companies get too expensive, they aren't necessarily fantastic investments. And that was certainly our thinking. What really concerned us was this existential, fear-driven capex around AI. And to our mind, the return on investment case wasn't clear. It seemed to be a case of you have to invest because it's going to be winner take all, and it's not about the returns on that capex. It's just about making sure that you aren't the loser. And that was a significant concern for us. The market was very positive about this capex and almost used the capex as the more capex, the more likely they are going to be the winners in the AI space. It's all about whoever's got the most money is going to win. And that narrative really took hold. The other thing is just to note that capex on chips amongst the Mag 7 actually boosts overall earnings within the Mag 7. It's an accounting anomaly, but basically capex takes a long time to get depreciated, whereas on the other side, that spend goes on to directly into revenues of NVIDIA, for example, and boosts those earnings significantly. So the capex spend, even though we're not sure that it's going to generate any proper return, was boosting earnings and feeding that narrative further. And then as we were out on the road, the DeepSeek news actually broke. Interestingly, we had been looking at it over a week before and wondering why the market wasn't taking account of that. And that once again just reiterated some of our concerns. And so ultimately, we bring it all together. We did think that at some point the AI bubble was going to burst, whether that was an extreme burst or just a slow deflation, we weren't sure, but we were confident that at some point in time, as is consistent with history and markets, that would deflate. And given the size of the Mag 7 and the amount of exuberance around AI, that was probably going to pull down the S&P as well. Whether that pulled down the rest of the world was an open question. What's interesting, though, is if we taking year to date and looking at it at the end of that week where after the Liberation Day announcement on the 2nd of April, we obviously had almost a week of extreme volatility. And then Trump eventually came up with the 90-day reprieve. At the end of that week, that's a good time to take and say, well, how has various indices performed? How have various parts of the market performed year to date? And as you see on the slide, the Mag 7 was certainly the weakest. It dragged down the NASDAQ, it dragged down the S&P. But even in an environment where the US was under huge pressure, the uncertainty was massive around the globe, you can see great performance, and these are all in dollars. Good performance by South Africa in a tough environment, strong performance by the UK. And then if we look at Hong Kong, proxy for China, and then the Bovespa, which is Brazil, very good performance from there. So our positioning actually has worked very, very well year to date, but it was more on a longer term view, which is in line with the way we invest.
Thanks, John. So the next question is from Jeremy and Klaus. Thanks, guys, for these questions that we've collated. So it's predominantly around the other side of the tariff coin that we're finding playing out at the moment. So our holdings in China, Hong Kong versus the US, John, focusing on valuation differentials and positioning changes. Could you possibly take us through how you view the unfolding risks and opportunities in China and the investment case for our continued holdings in China? What excites us about those investment cases?
Thanks, Nirdev. Yeah, I'll probably start with the valuation side of things as per the question. And if you have a look, and we'll bring up the chart on this, at the 1 year forward price earnings ratio, looking at the S&P versus the MSCI China index. And then you can see the longer term price earnings ratio, that's the 1 year forward, as I said, and where it is currently. And a couple of things are immediately apparent is you can see how the valuation of the S&P just moved away and moved up and got to actually extreme levels before pulling back year to date. But even after that quite significant pullback, you can see it's 22% above its 20-year average in terms of valuation level. So the S&P remains expensive, remains rich. You can argue whether that's underpinned by earnings growth potential, differential earnings growth potential, but as a pure valuation, it does look stretched. And then if you contrast that with the MSCI China, you can see it's at low levels. It's 13% below its long-term average. And then if you compare the two, basically China's trading at a 50% discount to the S&P 500. Now, just because it's at a discount, just because the valuation is cheap, doesn't mean that it's necessarily a fantastic investment opportunity. And China's had a very, very torrid time, really, since the extended COVID lockdowns, and then the deliberate decision by the regime to actually deflate the property bubble within China. What has happened is confidence is extremely low. There's a lot of uncertainty, but as you can see, some of that is reflected in the pricing. Now, it's obviously involved right now in a very, very tough trade war with the US. There's lots of debate and discussion as to who's got the upper hand, who's got more tolerance for pain. From our perspective, this environment is actually one where we always expected that there would be some sort of fiscal support coming through. We think the chance of significant fiscal support has increased substantially. And if you have a look in China, they've got an incredibly high savings rate. It's roughly 44% of GDP. And so if they stimulate confidence, that will drive immediately some sort of consumer spending that will rebalance the economy. And really what is required is that confidence. And we believe the strong fiscal support would turn that confidence around, and those savings would be available to actually generate quite significant GDP within China. And that is an adjustment to the economy that is definitely required. In terms of our positioning, that would really benefit some of our holdings like Bud APAC and Antisport, which would benefit from a consumer-driven revival in China. I think what's also just maybe underappreciated is people look at direct holdings in China. So we've got some direct holdings via Hong Kong listings, and that's where the focus is. But they forget just how big the exposure can be in some of the large cap shares. So whether it's in Nvidia, whether it's in Apple, whether it's a Prosus or Naspers, these have significant exposures to China. So we look through all of that and compare how our positioning is versus indices and versus peers, and we're very comfortable that we've got an appropriate level of exposure.
Thanks, John. So the next questions are from Mark and Daniel around portfolio construction. So I've reframed them slightly. So thanks, Mark and Daniel, for these questions. So, John, has PSG Asset Management had to revise what a well-constructed portfolio looks like under Trump administration? And in addition to that, PSG Asset Management typically in its multi-asset portfolios holds a higher allocation to South Africa versus many of its peers. Could you please talk to how you've considered the ever-present geopolitical risks that manifest itself in many forms, like the trade tariff war just about every country finds itself in right now, as well as the noise around an unstable coalition government in South Africa, rumors flaming the view that South Africa around land expropriation and BE practices is a top of mind within the US. Is this an environment more suited to focusing on generating strong returns or protecting capital?
Thanks very much, Nirdev. It's a great question, and post the Liberation Day announcement in the couple of days that followed, it was I was going to say entertaining, but that's not the right word. It was amazing to see how markets reacted, where we had both the tariff news as well as uncertainty around the GNU. And certainly the markets don't like that uncertainty, and it was reflected in some of the moves and some of the price drops. But in terms of answering your question, I think I'm going to split it into two. I'm going to initially take the global sort of question, the geopolitical question, and then subsequently deal with the GNU and the South African focus side of things. So I think after Trump's first period in charge, I think the market was expecting noise and volatility. That was a given. But what's become apparent is that he and his administration are looking to reset the US's role on the global stage and rejig global trade. And these are very, very, very significant moves. And the second and third order effects of these moves are really uncertain. We do know that this has the potential to really change everything that we've come to take for granted in terms of trade flows, and then ultimately that could manifest in terms of a significant change on the equity markets and even the bond markets, with a reset and what has worked in the past potentially not working going forward. The geopolitical implications are also extreme. And in particular, what makes this very, very hard is the about turns and the U-turns that are happening from a policy perspective. So I think, there's a huge amount that's going on. It's incredibly difficult to understand the ramifications of that. And that has implications for positioning and for how we react as this news flow unfolds. Back in 2021, we actually took the view that we were seeing a regime change in terms of markets. We felt that inflation was going to be sticky and high, and much higher for longer than a lot of the market expected. That has significant implications because higher inflation leads to higher interest rates. We had gone through a 30-plus year US bond bull market. We felt that had the potential to be coming to an end. And if you have inflation, it means that bonds don't behave like they would normally behave. If markets sell off because of inflation, you can have both equities and the bonds selling off at the same time. And that's exactly what we saw in 2022. But we didn't think that was a once-off. Inflation has come down significantly since then, and the markets assumed we're going back to 2%. We didn't think that was the case. Heading into Trump's inauguration earlier this year, our positioning was very much driven by where we saw opportunities, looking in those uncrowded areas, looking through our 3M process, moat management, margin of safety, for opportunities that we were excited about, where the market had missed it and the valuations were attractive as well. So the positioning was really sort of valuation differential driven in those uncrowded areas. And those uncrowded areas are often areas that are out of favor because the market environment doesn't actually benefit them. And a change in the market environment, which is exactly what we're seeing, can be incredibly beneficial if you're away from the crowded areas, which is our positioning. What we've seen from Trump so far supports our view that there has been this regime change. Bonds have continued to face pressure. After having come down, the services inflation has stayed high. And now with tariffs and immigration policies, even though oil has come off significantly, even though there are recessionary fears, there's still very, very strong inflation pressures in the market. And so our positioning, we haven't adjusted it significantly. We were already in a position that we think was appropriate going into what we've seen over the last sort of couple of months. The other things that I think are really important from a positioning perspective is this exceptionalism in the US has been dissipated, and we could have years of flows rebalancing by portfolios, by fund managers out of the US into the rest of the world. And just given the size differentials, that can create a significant tailwind for the performance of rest of the world indices, rest of the world stocks versus the US. The other thing to note is that the mega cap stocks have really benefited from globalization. We've seen how much they have come off with all this trade tariff noise. They are vulnerable to that because their business models are really around benefiting from globalization. So they are probably the least well positioned for this. They were the ones that benefited in the old regime. A regime change is not necessarily going to continue to benefit them. Another thing to note is we are seeing significant potential for fiscal support in Europe and in China. A lot of the US's outperformance could probably be attributed to the massive fiscal deficit they've been running. That basically is pumping the economy. And now Europe and China could potentially start to do that just at the time that the US can't afford to continue to use those fiscal deficits to drive internal growth. But that is essentially what they're looking to do with recently passed legislation. They're open to those deficits widening out even further. They're running close to 2 trillion. Those deficits could go to 3 trillion. And as a result, the focus on the fiscal situation and the focus on bonds could become even more intense. And I think it's a dangerous game because they are assuming that those bonds, because they're a reserve currency, that they won't blow out completely. I think they got a big fright post the Liberation Day when the bonds reversed direction after dropping to 3.9 on the US 10-year and moving all the way out to close to 4.6 and above. And so I think they had a big shock on that, but it seems they're still willing to go ahead running high fiscal deficits. And that is a concern that the market's going to watch very, very closely. In terms of South Africa and the GNU, yes, it is a concern, both in terms of the stability of the GNU and the potential for US interference. And what we have seen is as those risks rose, the markets did sell off. There has been a rebound since then, but they are still reflecting what we see as a broadened out range of outcomes. There are some more negative scenarios that we could see. There are still some very, very positive scenarios. And to a certain extent, with the risks rising and the bond yield selling off and some of SA Inc. Equities also selling off, some of that is in the price. But we do think with a widened range of outcome potential, one has to be cognizant of that. And so we are a bit more circumspect. We are very, very selective. And certainly in our lower risk funds, we think we are adequately balancing this extended range of outcomes and the increased risk that we are seeing versus the real yields that are available to us. Finally, in terms of, ultimately the question is, can you still deliver returns or should you go into protective mode? What we saw after the bursting of the dot-com bubble was that even though overall indices were under significant pressure, certain select stocks did incredibly well. And ultimately, you've got to be willing to be different. You've got to go in the areas that are out of favor. You've got to turn over a lot of stones and do a lot of research, but you can outperform. And we've done it before. And we think this is an environment in which selective stock picking is going to be incredibly beneficial. And that is what we do.
Thanks, John. I think, many people are starting to see the benefits of active in an environment like this versus indexation, rather than using the term passive. So active is definitely going to be the way one needs to play a world that is constantly in flux. Great to hear your views on that. So maybe this is, an extension of how we do our investment process. But one client has asked typically what we got right versus what we got wrong, especially in the last year, and maybe how we're going to manage those aspects that we got right and wrong going forward. And then Peter, on the other hand, noticed that we tend to have a tendency to identify opportunities a little bit early, and then we also leave the party a little bit early, so we divest a little bit early too. Can you maybe comment on that as well?
Certainly. So in terms of what we got wrong and what we got right, and once again, I'll reference to a slide that we used in the Outlook that puts us out pretty clearly. Focusing on 2024, we had resource exposure after a very, very strong period of time where it had done incredibly well for our clients. We did see a pullback in 2024. And so those hurt our performance. Our global positioning in 2024 was tough. We didn't have a lot of US. We didn't have any Mag 7. And I've talked about how significant they were as drivers during 2024 in particular. So that hurt. And then some of our real quality stocks, what we would call 3M stocks that are really highly rated from our perspective in terms of moat management and margin of safety, the likes of Anheuser-Busch and Prudential, performed very poorly in 2024. What's interesting is Anheuser-Busch, Prudential have performed very strongly year to date, and our positioning, as you would expect, given that chart I showed earlier of the relative positioning across FTSE, the UK, across Hong Kong, across Brazil in terms of performance, even in the SA side of the markets versus NASDAQ, MAS7 and S&P, we've done very, very well. So a lot of those did reverse quite quickly and quite dramatically. In terms of what we got right, I think I have covered that in quite a lot of detail. Our fixed income positioning was good. Our selective South African stock positioning was very, very good. And so I won't go into that in a huge amount of detail, but it's on there on the slide. I think the focus was more, and the interesting questions about what we got wrong. In terms of the question about us being early, both in and out, I think that's probably valid. Our process and our 3M approach means that we do look for those opportunities in uncrowded areas. We do look for where there's great quality at a good price. And ultimately, what can happen is you can get in, the sentiment is very negative there. And even though it's incredibly cheap, the sentiment can go against you and it can get even cheaper. What we've gotten better at is at sizing these opportunities, especially globally, allowing us to reassess if the share prices come down and potentially add to that position if we're even more convicted. And then because we've got our 3M process, because we look at margin of safety, because we look at the valuation, when stocks get expensive, we're comfortable to sell out of them. And sentiment, when something's been moving up, when the stock does well, other investors jump in and it can be taken to extremes. We don't always have that ride. And it's a dangerous ride because it's driven by sentiment. So the sentiment can take stocks too cheap. And as a result, we can get in a little bit early. And then on the flip side, the sentiment can take stocks too high and potentially we get out a little bit early. We are trying to get better at that, but ultimately it's part and parcel of our approach and our philosophy. It's a drawback of that approach, but there's so many benefits of that approach. And ultimately, we've delivered exceptional long-term performance with this approach, and we would expect to continue to do that. We're trying to get better, but ultimately it is a function of our focus on price and valuation and really taking the view that the price you pay for an asset is a crucial part of your ultimate investment outcome.
I suppose, in markets like these, you are finding great opportunities as the market starts with negative sentiment. And as you said, with the VIX picking up, it's creating lots of opportunities for us to find those great qualities that we previously may have said, hold on the brakes for a little bit longer. So the last question for today is from Spalding. Thanks, Spalding, for this question. So it's typically about, it revolves around blending managers with different philosophies, which can result in divergent performances through a cycle, and as you get through a market cycle. So Spalding goes on to ask, where typically do we see the current cycle from a market perspective, an interest rate and evaluation, and a growth perspective?
Maybe before I get into that question, just your earlier comment, and people might be interested in terms of how we experienced that extreme volatility post the 2nd of April. Going in, we knew about, obviously, Liberation Day. We debated it extensively. We did have what we felt was very, very good positioning going in. We had raised quite a lot of cash. We had good derivative protection, and we felt we weren't in the areas that would be most affected by a potential greater level of tariffs than the market was anticipating. We actually further sold some stocks on the day beforehand, just having a look at the range of outcomes and feeling it would be good to have some extra dry powder. And then we saw the stock sell off, and we were in a position where our derivatives kicked in. We had quite a lot of inflation-linked bonds, for example, that held up really, really well. And our stock positioning was really good in that environment, as you would have seen from that chart I showed earlier. And as a result, we were on the front foot. Yes, markets were tough. Yes, our funds were going down, but certainly well within the range of what we would anticipate, and strong performance relative to many of our peers. And that allowed us to actually, as we do in crisis situations, keep a level head, look for the opportunities, look for the quality that's gone on sale, and we were able to step in and buy quite a lot of shares, add to that exposure, and get them at really, really good levels. And I think that's exactly what our clients would expect from us. We've done it time and time again. We're very good in those crises situations, but our positioning was actually really good going into this one, and we were able to really use that to get on the front foot. In terms of the question asked, I'm obviously not the expert on this call in terms of blending different asset managers. That's not my game, but it's what a lot of the viewers on this call would do. But I'll maybe just give some perspective from our side. So if we have a look at, and we just take the ETFs listed on the US, value versus growth, and we have a look at them over various different cycles, interest rate, inflationary cycles. It's quite interesting to take the sort of key takeaways there. So firstly, over the last 20 years, growth has outperformed by 5% per annum. It's extreme. It was obviously after a period of very strong performance by value after the bursting of the dot-com bubble, but it has been a real environment where growth has outperformed. And that has been supported by momentum, and it's been supported by passive strategies and the growth of passive, which really sort of drives those large cap stocks, and the outperformers outperform even further. What's interesting, though, is if you have a look at the environment on the 10-year bond yield, once again, just looking at the US to get some data there, when bond yields are under 2%, that outperformance was 7.6% per annum. So lower interest rates, better for growth versus value. On the flip side, when the bond yields were above 4%, as they are now, that outperformance dropped to 1.2% per annum. So we had a period of outperformance. It was really distorted by the fact that passive would drive outperformance even further. So the fact that it was still a growth outperforming value, I think it's more about the pattern. And clearly you can see value does better relative to growth in an environment of high interest rates. That's not a surprise to most people, but it's worthwhile just sort of looking at the data. Similarly, if you have a look at inflation, when inflation in the US was below 2%, the outperformance was 5.7% per annum. Above 4%, it actually dropped to 0.7% per annum. And above 6%, you actually had a 17.5% annualized outperformance by value over growth. So we think inflation is going to be sticky, and Trump's policies will add to inflation. We've seen the fiscal situation, meaning that the bond yields have risen as well. And obviously inflation also drives bond yields higher. So we think we're going to be in this environment for a while. And we believe that this environment really does benefit those managers that are more value orientated. With our 3M process, with our focus as one of those M's on margin of safety, we do tend to perform better when value does well. What's interesting is, even though the environment has been one where growth has dominated value, and even though we're more affiliated with value, we've been able to outperform through this period and deliver exceptional alpha for our clients. But we do think we are moving into an environment that will suit us even better. The problem is 20 years of value underperforming. There are very few true value managers out there, those that are really focused on what you pay as a key determinant of the outcome that the investor receives. And so I would just caution people to make sure that when they look at their balanced portfolios, their blended portfolios, that they do have appropriate representation of value type of managers, because we do think the environment we're going into is going to be very good for value managers.
Thanks for that, John. And thank you very much for taking us through a couple of questions that is a top of mind on many investors' minds. Thanks for the sensitivity between understanding how to invest through noisy markets, but also addressing the issues that are at play right now. It's very difficult, I can imagine, to blend the balance between acknowledging what is happening on a day-to-day basis while thinking about making sure that you create good returns and outcomes for clients and the client journey, along which all of our viewers are seeking for in the best interest of the client. So thanks for showcasing how PSG Asset Management is thinking about this and making sure that we are delivering good outcomes for our clients. To the audience that's online, thank you very much for joining us today. We hope you found this valuable. We look forward to following up this with individual discussions with myself, your fund specialists, and portfolio managers. We are keen to engage with you and make sure that we are supporting you through a very interesting environment that we find ourselves in. As I mentioned previously, PSG Asset Management thrives in environments like this, and we look forward to navigating this uncertain world with you. Thank you very much for joining us today, and have a great day further. Bye-bye.